Welcome back, Daily Brainers. Today, we're unraveling one of the most dramatic stories in Wall Street history. When Genius Failed by Roger Lowenstein. This is the tale of long-term capital management, LTCM, a hedge fund that was founded by Nobel laureates and financial geniuses, yet collapsed in a spectacular fashion, threatening the global financial system. Get ready for a thrilling ride through arrogance, brilliance, and greed. Let's dive in. The dream team assembles. Our story begins in the early 1990s with the founding of LTCM. The fund was led by John Meriwether, a legendary bond trader from Salomon Brothers. Joining him were Myron Scholes and Robert Merton, two Nobel Prize-winning economists famous for their work on the Black-Scholes options pricing model. LTCM was hailed as a dream team of finance, using mathematical models to find arbitrage opportunities in the bond markets. Key takeaway: the lesson here? Even Nobel Prize winners aren't immune to mistakes when markets take unexpected turns. What do you think? Are mathematical models enough to predict market behavior? Let us know in the comments. The magic formula and early success. With their academic brilliance and unparalleled confidence, LTCM began trading in 1994. The fund employed complex mathematical models to exploit tiny inefficiencies in the markets. And it worked. In its first few years, LTCM delivered extraordinary returns, with annual profits exceeding 40%. Wall Street was in awe, and investors poured billions into the fund. Key takeaway: early success can breed overconfidence. Have you ever had a winning streak in investing or another area, only to find that confidence came back to bite you? Share your story in the comments. The hubris of genius. But here's where things started to go wrong. The success of LTCM fueled its managers' belief that their models could never fail. They ignored potential risks, assuming markets would always behave rationally. This hubris led them to leverage their positions heavily, borrowing vast sums of money to amplify returns. By 1998, the fund controlled positions worth over $1 trillion with just $4 billion in equity. Key takeaway: overconfidence and excessive leverage are a dangerous mix in investing. What's your take on leverage? Is it worth the risk, or is it a ticking time bomb? Drop your thoughts below. The storm bruised. The cracks began to show in 1997. The Asian financial crisis rocked global markets, but LTCM held steady, believing it could weather the storm. However, in 1998, the Russian government defaulted on its debt, sending shockwaves through the financial system. LTCM's models hadn't accounted for such an event, and its heavily leveraged positions began to crumble. Key takeaway: markets are unpredictable, and black swan events can upend even the best-laid plans. Have you ever faced a situation where an unexpected event derailed your plans? Let's hear your stories. The collapse begins as the crisis deepened. LTCM's positions lost massive value. Because the fund was so highly leveraged, even small losses were catastrophic. By September 1998, LTCM was on the brink of collapse, and the ripple effects threatened the entire financial system. Banks and investors panicked, as LTCM's failure could have triggered a global meltdown. Key takeaway: too much interconnectedness in financial systems can amplify risk. Do you think today's financial systems are better prepared to handle such crises? Let's discuss. The Fed steps in. With global markets in turmoil, the U.S. Federal Reserve stepped in to organize a bailout. A consortium of 14 major banks was assembled to inject $3.6 billion into LTCM, preventing its complete collapse. In return, the banks took over the fund's operations. The intervention stabilized markets, but it came at a cost, and raised questions about moral hazard. Key takeaway: bailouts can save the system, but they also create risks by encouraging reckless behavior. What's your stance on bailouts? Do they help or hinder the system in the long run? Share your opinion below. The aftermath: by 2000, LTCM was dissolved, and its legacy became a cautionary tale for Wall Street. The fund's collapse showed that even the smartest minds can't always outsmart the market. It also highlighted the dangers of over-leverage and the false sense of security provided by complex financial models. Key takeaway: no one is too smart to fail in the unpredictable world of investing. Have you read about other financial crises or collapses? What lessons stood out to you? Let's compare notes in the comments. Lessons for investors. So, what can we learn from when genius failed? Here are the big takeaways for investors. 1. Don't ignore risk. 1. Always prepare for worst-case scenarios. 2. Be wary of leverage. 2. It can amplify gains, but it can also magnify losses. 3. Stay humble. 3. No strategy or model is foolproof. Engagement tip: which of these lessons resonates most with you? Or do you have another takeaway from LTCM's story? Let's discuss. Conclusion: and that's a wrap on When Genius Failed. Roger Lowenstein's account of LTCM is more than just a thrilling tale. It's a powerful reminder of the risks and complexities of the financial world. Remember, even the best strategies can fail when arrogance and leverage take over. If you found this story fascinating, smash that like button and let us know what other financial tales you'd like us to cover. Don't forget to subscribe for more deep dives into books, investing, and financial wisdom. Daily_Brainer, empowering you, one insight at a time.